Hey everyone, hope you're doing well. This is the Deep Dive. My name is Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth, and I'm joined, as always, by John Creekmer, our founder and Senior Wealth Advisor. And John, we're here at the end of October, walking into the last 2 months of the year, which is crazy to think about. But what are you looking forward to as we enter into the month of November?
I'll tell you, I really am looking forward to the election season being over. That's it seems like we're in a continuous election cycle every single year, and so looking forward to that being past us, and hopefully we'll have some clarity coming early on in November, and should be able to move on from that. So looking forward to that, and that really lines up. I know that it's interesting. Our next holiday, October 31st, is Halloween, and the very next one after that's the election day, and so. Those are potentially two scary days for a lot of people, and kind of back to back. And so, whenever I see that, I just am reminded again and again that a lot of people they have viewpoints that say that if a particular party happens to win the candidacy and we have a certain leader within our governmental structure, the stock market will go up. And if we have another party in power, the stock market will not perform as well, or the bond market does better, and the bond market doesn't do as well. And, it's one of these things we look at that in history does not bear that out. And so we look at how markets perform and ultimately performs based upon the earnings of companies and the expected earnings of companies. And so we're going to caution everyone heading into the election season, number one, to make sure that you do vote. That is a phenomenal right that we have here in this great country. And so make sure you do your homework. Make sure you look at actual policies. Make sure you look at what candidates actually stand for based upon their platforms and their past history and how they've actually voted and led. And make sure you vote for the candidates that you believe, and this is not just federal, it's down at our local levels and our state levels. Make sure you're voting for candidates that properly align with your personal beliefs and values. And don't just vote along party lines. Make sure you do your actual homework and vote according to what your values are. So that's the number one thing, Drew. And following up on that is to make sure you don't make your investment decisions entirely based upon your political viewpoints. Those investment decisions can be informed by and rounded out by your viewpoints, but it shouldn't be simply standalone decisions.
Yeah. Yeah. And John, I think what's helpful, and you've talked about this a lot, is knowing the data, knowing the numbers. And so it's important to obviously know your values and where you stand and make informed decisions with those in mind. But on the other side of the coin, you also have to know the data and the numbers. And so let's just talk big picture where we're at today, here at the end of October, in the economy and in the stock market. So far this year, it's been another strong year for US based equities. And we are starting to see the bond market recover, which is a good thing. The last couple of years have actually been one of the worst periods in US history for US based bonds. And so it's a positive to see that as interest rates have come down, we're starting to see bonds begin to increase in value. And so that's been a good thing to see. But a lot of folks right now are focused, John, on the equity side of the coin because the numbers the last couple of years have been very strong. And John, one of the things we study is the history of bull markets. How long do they last? When do they typically end? And on average, a bull market will last 18 to 24 months. Well, this current bull market we are in actually started back in October of 2022, which means that we are sitting here right around the 24th month today. And so knowing that data point and knowing where markets are at, what would you encourage people to think about?
Yeah, to recognize that we look historically at where things are at, and that's a critical point in time, Drew. Is a bull market, which is from the most recent low up to the most recent high, as long as it exceeds 20%. Whenever we see that, that typically lasts 18 to 24 months. Now, we may go 26 or 27 months. It's hard to say. It's not an exact science that it will happen on this day. But we know in that period of time, we end up hitting a peak. And then from there, we go down to the next low. And the next low is at least a 10% pullback. And with that, that lasts somewhere between 4 to 7 months. And so I think you need to be aware of what history has meted out in the past. And that's going to happen regardless of who wins the elections coming up here in November. And so it's really tied into long-term performance and movements and timing of the market. So that being said, we're kind of in what we call this kill zone, and it's kind of when you walk into an area toward the end and probability we're going to see a little bit higher volatility. And it'll be some event that happens that triggers some level of a sell-off, and we typically don't know what those events are. It could be something as common as some earnings report does not come in as strong, or our forecaster is not as strong. And even, we saw a little while ago, ASML came out with a report saying their sales in China are forecasted to be not as strong in the fourth quarter. And then that caused the market to pull off one day for a singular announcement on something, a forecast on sales. But it could be something as far as happening in geopolitical. But whatever it is, it's a triggering event. And so in those periods of time, you want to make sure you have an overall plan and a strategy of how you're going to execute. Now, Drew, it's interesting that whenever we look at this history, we also have to look at where things are happening under the surface in the markets. And so when you look at advanced declines, when you look at volume up versus volume down, when you look at institutional holdings and institutional practices, we're actually starting to see what's called a divergence in a lot of individual stocks, particularly some high flyers that have done well the last year, and also in the broad-based markets. Well, what is divergence? Divergence means the stock market or the stock price continues to move higher, and yet the underlying momentum is actually slowing down. And so if momentum is slowing down, but the market's moving higher, that's generally a sign sometime in the foreseeable future, we should see the stock price actually go in the opposite direction. In this case, we're moving downward. So divergence, along with the piece of time of where we're at right now in the history of the market, it sets up for heightened volatility and maybe a pullback. And then, Drew, that's when you want to make sure you have proper allocation across the board in your portfolios.
Yeah, it definitely is. And John, the last time we saw that divergence that you're referring to with price moving up but momentum down was in the latter part of 2021. And if we all think back to 2022, the high in the market was on the first trading day of the year. And so it doesn't mean that's going to play out exactly like that, like John said, but it is just something to be in mind. And so, John, we believe that volatility could definitely creep up, which means risk right now is much higher than potential reward. And so can you walk through what we're doing in portfolios right now, just across the board, to make sure that we're capturing some of those gains for our clients from the last 18 to 24 months, but also ensure that no matter what happens, we're all going to be in a good place?
Yeah, I mean, I think the best way to say it is that no one is ever going to be able to 100% capture the absolute high whenever you're selling, nor can anyone ever capture the ultimate low whenever you are buying. And so if that's the case, we're simply looking to place trades somewhere close to the top or close to the bottom in the trend line. And so with that, we're looking to say we'd rather be out before things pull down strongly, even if we miss out from the ultimate high by a small percentage, and that's okay. We're looking for large macro trends and macro movements. And so across the board, we've been looking to find which individual holdings, individual stocks or ETFs or even broad market indices are starting to slow down as far as in their momentum and start to show a little bit of stress as far as on the upside and looking to gradually start taking profits, not sell for an entire position in most cases, but looking to decrease holdings reasonably in order for us to be able to harvest some profits that we've gained and be able to set the money in a little bit more of a higher interest savings account or high interest money market account or FDIC insured account to be able to keep the powder dry, if you will. So whenever the markets do pull back, we can re-enter the same high quality names at much lower prices. And so by doing that, we're actually lowering the level of risk across the board in most all portfolios. And so we're seeing that happen across the board in both the ETF models, but also the growth stock and growth and income stock portfolios.
Yeah, and we feel that we're balancing as best we can the risk and reward. And like John said, having that dry powder in place is a great thing, no matter what happens in the months ahead. What I would encourage all of you to do is, if you're concerned about how much risk you have in your investment accounts, reach out to your advisor. We have a new technology tool that all of our advisors will be using with each and every one of you during your normal strategy session meetings to walk through and assess how much risk you're actually taking today, and does that properly align with your goals, and really diving into the data there to help you understand what your potential reward, but also downside looks like in your investment portfolio as it's allocated today. And so, John, we've covered some good ground here and hit on a number of important topics, but what's one thought that you want to send us off into the week with?
I'll tell you, the biggie is that investing in the equity markets is a marathon. It is not a sprint. And so that being said, don't be focused upon short-term returns as far as your ultimate barometer on how you're doing. Focus, number one, as far as on your training. Whenever you're training for an event, whether it be a mountain climb, whether it be a run, what you're looking at is for incremental progress as far as in your overall fitness and endurance. It's the same thing here in your portfolios. You're going to be looking for signs that show your portfolios are stressed, but also that they're properly aligned as far as with the risk that you're taking and the reward you need to accomplish your goals. And so, number one, make sure you understand the risk reward ratio in your portfolios. Like Drew said, we have some phenomenal tools that we're bringing online that will actually be able to help you see very clearly where you're in alignment, not alignment with your goals. And the second thing is you want to make sure that you're always investing every account with a purpose. What is the statement of purpose? And that purpose really comes down to two areas. Number one is time frame that you're going to need the money. And the second one is the dollar amount you're going to need. And so based upon that, that should help you align your risk with your reward to make sure you're be a proper balance inside your portfolios.
Yeah, absolutely. So if you're curious about that, we'd encourage you to reach out to your advisor. Don't worry though, if you're busy or tied up, you're at your next strategy session. Each of your advisors will be walking through that exact analysis with you. And we believe it's going to be a phenomenal conversation to help ensure you have alignment with those big goals that you guys all have. So thanks for the time, guys. We really appreciate each and every one of you. And we look forward to talking to you all soon.